Hello guys, and glad to have you on board again. Today had a lots of requests about S&Ps or indices in general over the latest 48 hours, so I thought it was worth it to eventually spend some time making a public video answer about these questions to fully cover in extent all of the things that you have to know about the indices. Once again, I don't know the truth, I don't know the future, I don't know anything of it, I just risk manage, and this is exactly what I'm going to be trying to do in front of you guys today. So what my analysis of the S&P 500 is, most of you guys, if you've been listening to me already, probably will have listened to this already, so this will be kind of a good reminder. But for those who did not, well, at least I'll try to do this in a fully extended way. So we're going to do a two-type of analysis today because there's been two questions rising. The first one being, well, what the heck is going on with the stock market, where we're headed, and then in that perspective I'll do a fully extended review, meaning that as a trader's perspective I will not define any time frame to trade on. I will just scroll the time frames to figure out what is the main pattern, the most probable and larger patterns being at play, and where are their technical risk limitations areas. And on the second hand, because there has been clearly a huge demand recently over the fact that most of the YouTube content and Discord content has been upon very high and large time frames, and that in that perspective you guys were lacking of shorter time frame context to deal with. So in that perspective I'm going to listen to those comments, and I'm also going to do a second analysis with more limited vision, in which I will split apart anything aside from a couple of time frames, which is going to be 4-hour and 1-hour charts, which normally in these reference time frame you should get a trade each and every week. So we're going to do a second analysis for these ones. Okay, so here it is. Let's get it started. First one, most important one, by the way, in my personal opinion, the trader's perspective using my strategy, and this is one out of many other strategies, and this is really what this is all about. Just trade your strategy. Don't listen to the noise of everyone else's what's doing. This is really not what trading is all about. We're not seeking truth. We're just seeking risk limitation of whichever truth you want to follow. So it's really what this is all about. But there are some truths that just can't be followed. Okay, so this is really all about that. Follow the narratives that have actually ground. Okay, so right now lots of people are getting absolutely stupidly orientated, though I'm going to try to make it clear. We're going to scroll from the larger time frame down to the quicker ones until we find something that corroborates one of the patterns that I know. Okay, and we're going to try sticking to the most conventional ones, not the expert stuff. So here it goes. Okay, so monthly chart time frame is where we start our analysis with, and well, we already got something. So this is a trending market, not because I want it, not because it rises or whatever shit that is. I have a set of rules that just tells me this is no way a trend, a range, so this can be only a trend. But in order to sequence that trend, I need to figure out if this is the primary trend or not. As a quick reminder, you've got all of those information summed up in the Prezi, which we're going to be using today as well as a reference. Just give me a second to grab it. Okay, there it is. So as we are in a trending context, here we go. And first of all, we need to make sure that there are no trends on the higher time frame. We're okay with that. And we need to make sure that this is preceded by a mature range, because things that look like trend but are not preceded by a mature range are not going to be sequenced as our primary trend. So this can be some other stuff like trending ranges or more complex structure, but that will tell you one thing, that you're not looking at the appropriate time frame. So in order to make sure that the trend we have seen on the monthly chart is one that we can sequence properly as a primary trend structure, or eventually altnet if we have some misconceptions with the structure, well, in that perspective, we at least need to make sure about these two. So let's go dive deep this road. Okay, switching on my button, sorry. Okay, here we go. So in here, do we have a preceding range? Yes. Do we have a trend on the higher time frame? We cannot study quarterly updates in here, and that wouldn't be the case anyway. So here we go. Okay, we've got our range, and we do not have trends on the higher time frame. So this is really our main sequence time frame. So what we should do next, that we've highlighted a primary trend structure, is to figure out how mature is that trend. So we know that the first thing we need to identify is the breakout structure, which should break out of the range, break sideways cycle. We should install closes above the resistance context, and afterwards we should see the moving average settling itself below the context. As contexts rise, they rise faster than the average prices do. So in that perspective, yeah, we have a trend. The question now is, how far in that trend are we? But there's one thing you need to understand. When there's a trend, you never ever go against the trend. The trend will have different maturities in which we do different type of actions, but this is one thing that we cannot just erase or whatever. There is a clear trend in the S&P 500 in a monthly reference, and we're far being over with this. Okay, so as the breakout in here, the next stage for the maturity of the trend is to figure out to double out the range out of the breakout points, and to figure out if the range has been doubled up. This is going to be acting as our confirmation level, meaning that the trend has fully extended itself. It's now going to move into more advanced stage, which means we're going to generally have a couple or more of trend follow structure, meaning that as there are no sellers in these markets anymore, every retracement is going to be bought on lower time frames, trend following perspective strategies. So all of this, once again, in the Prezi video, in the Prezi stuff, so not inventing anything, just applying a goddamn strategy. So the thing is that if you follow the rules, the two trend follows are here. Another thing that I teach you is that out of 2 trend follows, we stop doing this, meaning there are rarely 3 and more trend follows in a trend. The 2 trend follows generally reach out to another set of intermediate maturity, which is the divergence pattern, meaning that at some point, normally the market is supposed to slow down, meaning that it still goes higher highs and higher lows, but it's going to start slowing the pace, meaning that the bulls start to lose a bit of control. They start taking profits, by the way. It's not the end of the trend, but the divergence generally looks like a market who is slowing down. And as this market slows down, okay, what we're going to start to see is momentum divergence, meaning that the momentum will fail to make higher highs as the prices will do. Well, do we have such a thing? No, we do not. So the thing is that there has been 2 trend follows, meaning that we no longer trend follow that pattern, that trend. There has been 2 attempts, they've been very successful, and we don't go down this road again. It would be too dangerous to try doing such. So in that perspective, the next step is divergence, and the following one will be the pullback. So what we know is that now we're headed into a pullback, but before that pullback occurs, if we want to trade, the only tradable maturity is going to be the divergence pattern, which is a counter trend trade, meaning that we're going to trade bearish in here. Either you're going to sell or cover the portfolio, but what that means is normally in a divergence context, what you do is you take fucking profits. That doesn't mean you short sell the market completely naked. That just says if you have a bullish exposition to that asset in particular, which is in here the S&P 500, so broad market value of US stocks. So in that perspective, what that tells me is that there hasn't been anything so far to sell that market. Instead of having a divergence, what we have is the market context pulling itself very violently to the upside by breaking both the support and resistance context boxes. So that tells me another thing. This market has gone excessive. Okay, so the trend, instead of slowing down, has decided to accelerate. So that's another thing that we need to account in the risk management. That's something I know. A market excess has multiple reasons. And if they're not fundamentally driven, meaning reduction of supply, then there's going to be a problem. That means eventually the demand is skyrocketing, could be a sign of a bubble or a market excess, and we're going to have to deep dive into the reasons leading to that excessive demand. But the fact here is that the answer is way simpler than that. In here, that's the supply side of the equation who's been actually severely impacting. We're looking at the S&P 500 in fucking US dollars, accounting that the US dollar in circulation has nearly doubled over the course of the latest couple of years. So how come the market is excessive if the supply side of the equation has been severely impacted? So yes, the market has gone excessive, but we have a clear reason explaining this. The amount of dollars in circulations have been severely increased, meaning that everything that is trading against the dollar had to go up. It's just as normal as it is. That means actual value of these stocks haven't nearly increased, but their price did because of the numbers of dollars circulating. So in here we have a market excess that we can Of course, this is more complicated than that, but we can give a rational explanation to this, to the simplest side of this equation, the one that we can truly measure, the fucking supply side. So this is what this is all about. This market excess that we see here is somehow justifiable. So if it is, that means, well, can we trade the divergence? Well, fuck no, because the momentum has skyrocketed, making higher high points, and coming out of higher low points as well. So we do not have a momentum divergence in here. The only thing that we could get to trade that thing and to be able to trade the divergence pattern would be going all-time highs again with a divergence momentum. What I would notice is that we already broke the previous low points. So there is a significant chance that we build that divergence now, and we're going to have a contradiction between momentum and prices. If prices build out of higher low points in prices, and higher high points as well, when the momentum does the opposite, well, here we're going to get the divergence that I would like to get. So here is my answer to these. If the market has to trade that divergence, meaning that professional investors locking their gains ahead of a pullback, which is nearly a crash or whatever that is, but just a consolidation in a trend, which is the next maturity stage. And even if we get that pullback, we're going to have to pull back, meaning finishing a monthly cycle, having a mature range within the trend channel. All of those rules, same thing, are in the crazy. But the thing is that we're inevitably going to go all-time highs again because we're going to have to finally access that trend. So in that perspective, in order to move prices from area A to area B, we're going to have to find out some more maturities, meaning that we first need to find a pullback. And if we want to speculate on that pullback, we need a divergence pattern to lock on our profits, waiting for the pullback to build itself, and then we're going to buy again. So this is really what I will trade within the next few years, because that's just what the indicators tells me to do. I have my regular structure. I see irregularities with that excess in here, but I can explain the sources of it. I don't nearly think that the market is now entering deflationary stage, meaning destroying the dollars that have entered circulation. I think that what we're going to get instead is a serious reduction of the new dollars going in. So what I think is we got to go on some kind of a step sequence, meaning we've seriously increased the supplies of dollars, and now we're going to leave it the way it is, not deleting the dollars. So in that perspective, the boost that we've got with that market excess, I can necessarily say, not with a 100% chance, I don't know the future, that there is a significant chance that it's going to be maintained, meaning that the prices will not reverse and reverse course of that excess, but the prices will not necessarily change anything, meaning that we've gone excessive, and the best we can get now is go all-time high to create a divergence pattern where all smart money investors will lock on their gains on their assets. That doesn't mean that they will take them all out. That just means they will take partial profits. Talking about those who've been stopped buying all of that trends or intermediate trends maturity. So the trend's not over, definitely not. What is ahead of us is either a pullback without a divergence to trade it. So we're going to have to let the pullback build itself, and we're going to have to take profits on the third range boundaries instead if this pullback fully plays itself. Otherwise, well, I think we have significant chances to go all-time high, and this is where the next speculative area will happen. So this is for the monthly vision, and we do not have to go anywhere beyond that. Even though there is a trend in the weekly chart time frame, this trend is a subsequence of the monthly main sequence, which we can definitely see is still at play. So we're far away from seeing the market top of the SP 500 within the next few years. We're going to go all-time highs because that's what the structure tells us. That doesn't mean that the divergence will be there. It's a speculative context. It doesn't mean it will happen. It just says that if I'm willing to take profits on my stocks, here's where I'll do it. I will pay real attention to the third range boundary in here. If we are already in the pullback, then there's going to have to be a third range boundary, and then I'm going to let that pullback mature. If that pullback has to play itself, we know where it's going to go. The pullbacks have to terminate a cycle, and they will generally be traded when prices are near the Fibonacci levels, being 23 as a bare minimum, 38 as a classical recurring one, and 50% as a kind of an extended correction in very rare cases scenario. So this is what it is. I'm sorry to say it, folks, but that's all I have to say. If you are willing to sell on an area which could be the first area of support of a potential pullback, then that's a pretty dumb scenario to me. That's also not accounting the fact that if you even sell with a stop loss in here, I think there are reasonable probabilities that it will go all-time highs again, even though that will not be settling crazy amounts of gains, but just pulling out a divergence, exiting trades at a pretty nice price. portions of trades. Very important second factor, okay? It's not getting all out and raging, selling all the stocks, but locking some partial profits for these because we can extend few months or a few years afterwards of sideways price action. Sideways doesn't mean bearish, okay? Sideways means range, meaning some assets go up, some assets go down. You can still be a buyer, but you're going to have a mixed approach in the market, buying some things, selling some things. Okay. So that's it. Now, if we want to just give it a bit more analysis to this, because I know you guys are asking for it, what professionals do generally when they have multiple sets of occasions and multiple sets of potential scenarios, we always have to go down 2 steps below, like 2 timeframes below, to try figuring out if the underlying structure 2 timeframes below can give us any clues on the probabilities to go one way rather than the other. So I'm just going to go seeking for informations in here, not necessarily tradable ones, but trying to find risk limitations due to the structures that will orientate me one way or the other. So in here, what I have is a range preceded by a trend, but there is, oh boy, where's the range preceding the trend? It's, boy, goddamn fucking really weird. Here would be my range, and I'm supposed to get a bullish third range boundary before we break, and I don't have such a thing. So the fuck is that? I mean, we come out of a major low point, the market goes bearish to bullish, we're breaking supports, and then we're breaking resistances. Oh, I know that structure. That's not exactly the typical way of trending. That's the things we've talked about earlier. So back to the Prezi, okay? In here, we have huge alternative problems. We see that there's abnormalities in the structure, so what the hell's going on? Maybe we should have a look at alternative structures. And, well, the first wave extended. Oh, that's exactly what we have. The market moves as a V bottom and goes immediately break the previous high without creating pullbacks. The moving average is settling itself below the context after being above. So we've got a kind of a 180-degree reversal without ever testing the support trend channel, the support context. So there is clearly something odd with that pattern. What it tells is that at first, a classic pullback will occur. It will be followed by a classical final exit structure, and in a second stage, we're going to create a second pullback, which will be positioned on the overlapping area of the previous resistance, and it will produce a second and last final exit structure. So that's something I know. That's my pattern. I've definitely seen that pattern at play in here. We definitely do the same thing, right? We're breaking the resistances. The moving average is selling itself, is pulling itself below the context, and we have definitely reverse course on a 100-degree with a V-shaped reverse. So we've got it all. So what do we know about that structure? It's going to pull out 2 pullbacks. So where's the first one? Well, we're actually doing it now. That's the first time we've actually finished a bear cycle. So this is the first of our couples of pullbacks. So assessing the things that I know, meaning that I don't predict the future, but statistically speaking, they're very well relevant. So in that perspective, well, I'll follow my rules, and I will tell with reasonable confidence that I think we're not over yet, and I definitely think that we're going to go all-time highs again, because that's what this structure tells me. I don't see 2 pullbacks being overlapped one to each other, so they are still to come. And in that perspective, if that is the first one, yes, it's a profound one. We didn't have to go that far. We could have stopped that pullback right by March, but still we decided to extend lower. This is no biggie. It's still possible. We're still trading something that looks like a pullback. There's a mature range on the lower time frame. We've finished bear cycle. We've actually pulled out 2 of them, but that's really the end of it. So if this pullback, now being mature, is what it is, and if the structure is the one that I currently have selected as very likely, well, we're going to have to do a final excess, then create a second pullback, which would normally build the previous resistance as a support, and we're going to have to do a second final excess to terminate the structure. So when I was trying to figure out the probabilities of either already being in a pullback now or go in all-time highs again to create kind of a divergence pattern and then build a pullback, well, now I have some hints coming from the more advanced analysis that experts will do by looking at informations on 2 timeframes below. Well, I can see that there is some definitely alternate structure being at play, and that if I follow these alternate structures and they tell me that we still have all-time highs to make. That doesn't mean I will blindly follow this. This just means this is what is statistically the most valuable to me upon my strategy's rules. So this is what it is. I know what I'm going to do in each and every case scenario. If we're already on a 180 degree and we're already starting for the monthly pullback, well, all I know is that we can trade these areas for long. I will wait anyway to create a third range boundary in here in order to risk limit my personal exposition to the portfolio. Meaning that I will not sell on supports. If that thing happened, well, the pullback can lead us into the next area eventually. That's not a guarantee as well, which will be 3,200 approximately. And this is the area in which it will be interesting to buy again, meaning that I will take some profits on my shares on the portfolio and sell some of them, which would just be serving as buying them back in at a cheaper at a discount. It's basically all about it. Okay, I'm going to arbitrage the range, meaning I sell high, I buy low, and I will target the same assets, meaning that I will sell a portion of my shares to just buy more of them with the same taken profits amounts. It will just be risk limitation in a range, knowing that anyway, after the pullback comes the final excess years away from now, in which I will lock all the gains. Final excess means I'm going to get the hell out of it, selling everything, okay? We're not yet there, in my personal opinion. Okay, so that's it for the first global analysis. Now let's dive deeper into the second perspective that we've highlighted. We just in here put the blindfolds on, and we're just going to look boringly at 2 time frame with a bracket, meaning that I don't pay attention to whatever happens above or below. I'll just look at these two to try figuring out if there is any risk limitation that I can follow. Okay, still following the rules. I put my blindfolds on, but I do not bend the rules. Okay, so let's have a look at this. We're going to start with the H1 time frame and try figuring out the context real quickly. Okay, so here we are. We always look at one thing, just don't try to pull out the story from left to right. That's what dumb traders are doing. So real thing is that you look at the latest 5 context boxes first, you try figuring out what the hell's going on now, and then you will eventually scroll back in time to give any sense to this and to confirm potential structure. But you highlight the structure first, you filter out the improbable scenarios. So we have a bearish moving average that is sitting on top of a bearish context that has just been reversed. Okay, the context has reversed, and we can see it from this one passing from red to blue. So now the channel is building to the upside on an oppositely trending kind of context, as the moving average is above context. So what is that? It looks like a trend which we're trying to reverse. So when the context is reversing against a falling moving average, that means we're going to get a third range boundary, if not already. Okay, so pure and simple in here, everything's in the Prezi, no biggies, okay? We have a range by opposing 2 factors, bearish one and bullish one. And in that perspective, as this one is preceded by a trend, well, third range boundary. So I know that if we get to touch that bullish rising context, there's going to be an interesting trade to make, okay? But first and foremost, there's a few things that I need to make sure of. Prezi again. Okay, let's zoom out because we're now in ranging contexts. So range, it is a third range bound because this one is preceded by a trend, but make sure that the contexts have been rejected. That's what it is. And we're not ranging on the higher time frame, okay? But it's okay if the range is settling itself in 2 time frames above. So let's make sure that we fill up that rule first, okay? If we want to trade that third range boundary, we need to make sure that we are not in a 4-hour range. And if we are, then we want it to be inside a daily range. Otherwise, we pass on that trade. So 4-hour, what's the 4-hour context? Come on. Okay, so we've got a falling moving average, okay, and a falling context in here, but we can see that this is not a trend. This more looks like a weird type of range. But anyway, the first things we're going to have to do is, as this would be more like a range, therefore we wouldn't be able to trade the H1 time frame reference, we need to have a quick look at the daily. If the daily is in a range, and it is, moving average is inside the context, moving average is rising in context of falling, so we do have a range in here. Congratulations, you can trade your third range boundary on the H1 time frame. So if prices go there, I'm going to buy them. No questions asked. Of course, that depends on the signals and stuff like that. Prezi again. If I go there, now I've validated my early rule, so I can open up the third range bound. Okay, I know everything about the third range bounds. They can take multiple structures, but there are two ones that I can trade, the neutral and trending third range boundaries, all following their own sets of rules. You follow the old things, okay? So having all of the conditions required to trade those third range boundary, either being neutral or trending, I'll definitely take the shot. This is what this is all about. So I have a trade to perform in the H1 time frame if and when the market goes back to the context. Now that the context is bullish, I'm just waiting for retracements to find bullish opportunities. How I'll trade them depends on the two patterns, trending or neutral, and that depends on where we're going to be against these context. Are we going to reverse inside or are we going to close below? And that depends on the sets of signals that I'll get as well with it. Okay, that's really all about it. No more complicated than that. The H4 time frame is no interest to me because it is in a range inside a daily range. So the range is in the daily chart, though I don't trade 4-hour because that's the time frame right below the major range, but 2 time frames below is okay. It has to look like a trend in that perspective, and it is, though we have third range boundaries to trade. That's really what this is all about. First range boundary, second being built as we speak, and you don't know how to trade second range boundaries. These are expert tradable contexts, so you certainly don't try to sell the market in here. You just wait for the third range boundary, which will be the lowest risk trade in that ranging structure. That's all about it. Okay, it's really, really not that complicated. We're in a daily range, which is already mature. The third range boundary has been bearish, and it's been in here, which means we already reached out its target. It's no longer time to try trading that daily range, but that doesn't prevent you from trying to buy third range boundaries on the lower time frame, be it the H1 reference and certainly not 4-hour. Okay? So I've made those two analyses, the longer term one and the shorter term one, in which I think there is a bullish third range boundary to be traded in the H1 time frame. I think this one is forthcoming, but I'm definitely waiting for this to happen, not calling that a mandatory shot. On the bigger picture, I think there is still way, way, way too much bearishness in this market, and that is actually, I think, untrue. Looking at the structure that I have, the worst we could get is a monthly pullback, which means the market will be boring for the next 3 to 4 years, and that's, well, the area in which I'm willing to sell, meaning profit taking on my shares, is certainly not on support. I'm going to wait for a third range boundary to be built. On the second stage scenario, I will wait for this market to go all-time highs again and build a divergence pattern, because that's what the daily pattern tells me, that we still have a couple of final excesses to make, and that therefore I will start locking on my gains in here and finish the pattern mostly at the second market excess. So I will probably lock 10% gains in here and another 15 to 25 in here, mostly depending on the signals that I'll get into the divergence pattern. But of course, we'll have plenty of time to talk to each other again until then. Today, I just wanted to just unpack the bigger things of this. There are definitely some contradictory signal. The reference time frame is monthly, so yes, there are plenty of things being at play. I think the market excess that we've seen on the monthly chart time frame will not be reversed. They are due to market reactions to increase in dollar supply. And even though you might want to talk about that extensively, I will say that this is just a fundamental effect. You increase supply on the opposite axis, meaning that the prices of the other ones, the prices of the counterpart of that trade, which is the shares prices themselves, have to rise. This is just pure and simple math. So in that perspective, some people think that we're going to destroy that market excess. That requires only one belief, that we're going to head into deflation, meaning that after creating money, we're going to destroy lots of it. And that's the only reason why we could unwind that bullish market excess. Otherwise, I think this is an excess. And the only thing it's going to create, it's that, well, it's going to stay there. We shifted price higher because we had to, due to the dollar amounts and circulations. Okay, so that's all about it. And in a shorter time frame, we're still under bearish trends in the H1 time frame. These trends definitely do not follow a trend sequence, okay? As you can see, there is nothing like we know about trends, okay? There are no breakouts, there are no mature range we're breaking out of, okay? This is definitely not like the SP500 we've seen on the other direction. This is just like a bearish range. As you can see, there are multiple bullish oscillations. So this is just a market that is fully dominated by the bears, but that doesn't mean the bears have total control. the bears have some pullback. So this is not a trend structure. This is just a bearish market. Sufficiently bearish enough that we can trade all the positive third range boundaries that will oppose itself. If I had to go one bite more aggressive in here, I would say that we already have two third range boundaries. The first one being in here. This one has been totally squeezed out and it's been sold again on its pullback. We've got a second third range boundary which is in here, comes out of a delayed third range boundary pattern which has created weirdly this bottom in here. So I would say anyway, there's one another in here. And there is a third one that's going to come. So this is more like an advanced kind of teaching that I give to those who already know my strategy well enough. But we are finally but steadily studying the third range boundary alignment patterns and their structures. So the first one has been squeezed, the second one has been delayed, but it's been a bullish one, meaning that we broke the second range boundary level. Okay, so this is kind of better, but it's been a delayed, meaning not many traders have been able to trade it, but it's still an important factor to account. The first one squeezed, the second one is delayed, and the third one, if it is bullish, I'm definitely going to buy it. So that's more advanced, kind of bringing a bit of salt on top of the main dishes. And here, in that perspective, this is really what this is all about. If this third range boundary is bullish, I'm going to be more aggressive and I'm going to keep a portion of those gains to trade the higher contexts, the ones that we've told. But this is really for more advanced traders, okay? For less advanced traders, make it easy on you guys. If you trade on the long term, there's still more gains to come. The worst case scenario would be a pullback and you want to sell the third range boundary of that pullback and don't try to be too much bearish. You still want to lock on some profits. If we return to all-time highs, it's not going to be a time for celebration. It's going to be a time for locking on some due gains. And anyhow and anyway, we're going to go all-time highs again. It's going to take years, of course, because monthly chart reference time frames. But even if we have the pullback, there's going to have a final excess. So if you think that we're on the verge to crash the market, this is the end of capitalism or whatever, feels very unlikely. Okay, and that's going to be it for today.